Welcome to the Climate Policy Initiative webinar on the global landscape of climate finance, a decade of data, based on a report of the same name, which was published last October. In case you're unfamiliar with CPI, we're an analysis and advisory organization that helps governments, businesses, and financial institutions drive economic growth while addressing climate change. This webinar will be presented by some of the CPI analysts who were heavily involved in the production of this report, Bison Aron, Jake Connolly, and Paul Roseanne. The format will be a half-hour presentation followed by a question and answer session. You're welcome to submit a question at any time via the Q&A button at the bottom of your screen. This webinar is being recorded and will be available along with the slides on the CPI website in the coming days. So now I'll turn it over to Baisa, who is a manager in CPI's Climate Finance Tracking Program.
Right, thank you, Caroline. So it's been over a decade since CPI analyzed global climate finance flows. And then in doing so, we aim to build the most comprehensively available information about the scale, key actors, instruments, recipients, and users of finance supporting climate change mitigation and adaptation activities. Just as a background, previous editions of this report has served as a basis for the Intergovernmental Panel on Climate Change reports, chapters on climate finance, and we also support the UNFCCC's biennial assessment and overview of climate finance flows. So global landscape of climate finance is really a core aspect of CPI's wider climate finance tracking strategy. So in addition to global landscape, we also do dedicated climate finance analysis at regional, country level, subnational, and also deep dives into certain sectors and thematic areas such as energy access, agriculture, methane, and many more. We then assess the progress against climate finance needs in specific regions or specific sectors to answer the question how to better direct capital to where it's needed and track the progress made in meeting those needs. So throughout our tracking work, we aim to provide actionable recommendations to policymakers, investors that will help catalyze investment in climate solutions. So just on the agenda, in today's webinar, we'll cover the key findings from our study, including the trends in the past 10 years, but also the most recent trends from 2019 and 2020. We will then go into various breakdowns of the total landscape of climate finance globally, including the users and sectors, geographical splits, and then we'll go into details of the instruments and public and private actors providing those finance. Please note that we will provide the information investment totals in US dollar terms in annual averages. And then we'll follow with a brief description on our conclusion on opportunities to scale climate finance and key topics to look out for in 2023 as we navigate towards COP28. And of course, we'll have some time for question and answer in the end. Now let's begin with the key findings. In this diagram, you can see that public and private actors have been steadily increasing their climate investments in the last decade. And this trend line suggests that the cumulative average annual growth rate was around 7% between 2011 and 2020. So what this means is that every year, public and private actors have been incrementally providing more and more finance towards climate mitigation adaptation activities. And as for our early projections of climate finance in 2021, we estimate that it would exceed 800 billion, which we believe it's related to expansion of investment in transport and mobility sector in the private sector, so particularly towards electric vehicles and the related infrastructure. And for public sector, there are also increased climate finance commitments, for example, from development finance institutions, but also from other donor governments. But please stay tuned because more precise analysis and numbers for 2021 and 2022 will be available in our next edition of Global Landscape, which we'll be working hard this year to release before COP28. So just a quick clarification on what we mean by climate finance and how we define it. So broadly, it aligns with the operational definition of adopted by the UNFCCC, So we put the definition on this slide, but also our assessment of climate finance is global. So what we mean is we track both international and domestic climate finance. So this really goes beyond the 100 billion goal from developed to developing countries. And then in doing so, we focus on primary investment in climate finance, which means we look at real investment in physical assets, projects, and activities on the ground. So we'd exclude things happening on the secondary market transactions. So things like buying stocks in a green company and things like that. So our method really looks into financial commitments to concrete projects and activities by public and private actors at the financial close of the year. And I'd like to highlight that we take due care in our methodology that we've been developing over the years, and we always aim to present non-double counted numbers, maximize data granularity, and also we have a principle of conservativeness when reporting our numbers. But of course, we have even more detailed explanation of our methodologies on our website, and please feel free to review them on your own time. So although private sector contributions are increasing, public actors have most recently provided the majority of climate finance. So this highlights the need for more private capital, but also enabling environment for such capital to flow where it's needed the most. And there's also a need for more sophisticated approach by public sector to take more risks and a clearer mandate to mobilize both public and private capital, and also to help create enabling environments necessary for unlocking further pools of capital. So on top of this challenge, there's still a significant gap between the current flows and what is needed for a successful low carbon transition. So as you can see here, there's a huge gap between the current annual average and also what is required as climate finance needs based on various scenarios. So these studies on climate finance needs explore ranges of investments required in physical assets based on different climate pathways for net zero by 2050. So what there's a clear message that the incremental increase of 7% that I showed earlier in climate finance in the past decade, this trajectory is not going to be sufficient. And based on our calculation, we need at least 20% year-on-year increase of climate finance to reach our climate objectives. So just to be clear, these trillions that we talk about are not unrealistic numbers or unavailable funds. The money is there. So on this slide, we made a comparison of how much global climate finance stacks up against just fossil fuel subsidies in only 51 countries. But of course, we're not naive that energy access is vital, but such subsidies are not helping our longer term transition to net zero. And this is why finance gap is not just a question of making new money available for climate, but it's also about redirecting existing inefficient spending and rethinking our financial system to make all finance flows consistent with our climate goals. Now, let me quickly provide an overview on how to navigate through the Sankey diagram for our landscape this year. So this diagram provides a snapshot of climate finance flows through its life cycle. And then on the left-hand side, you'll see the capital sources and intermediaries. These are categorized into public and private, which are then further broken down by categories such as commercial financial institutions, development finance institutions, government actors, etc. And then we see the instruments used to raise such funds. These are debt, equity, and also grants. And every financial flow is broken down into mitigation, adaptation, and dual benefits finance. And then finally, on the right-hand side, we show the economic sectors where this finance is spent. All right, so I'll hand over now to my colleague Jake, who will take you through to climate solutions. Thank you.
Great, thank you, Lisa. So going back to the global landscape results, we'll now dive into the climate finance flows of the last decade and try to understand what climate mitigation and adaptation solutions were invested in, and also where geographically these investments were flowing. Next slide. So if we look at mitigation financing first. So from this graph, we can see renewable energy and power generation continues to be the main mitigation sector into which climate finance flows, going from 232 billion a year in the beginning of the decade to 346 billion in 2020. And this reflects a maturing market in the renewable energy sector, the majority of this financing coming from the private sector. And one note of optimism here is that due to the falling cost of technology, specifically around solar and wind, $1 of investment in 2022 results in a much greater increase in generating capacity installed than in the beginning of the decade. If we move down the graph, low carbon transportation has increased significantly over a fairly short period of time, growing 7-fold in the last 5 years alone. And this is mostly a result of the Western European, North American and Chinese markets. And here, as in renewable energy, it's technology improvements as well as governmental policies that have been crucial in facilitating this growth. And though we expect to see some economic headwinds, which may dampen some private investment, we hope to see these positive trends continue and accelerate in this decade as governments commit to significant investment in these sectors. And whilst growth in these sectors is welcome, more finance is needed for both of them, and even more so in sectors that are currently underfunded. So, for example, agriculture, forestry, and other land use we know cause around 18% of our greenhouse gas emissions. However, it receives less than 3% of climate finance. And so the bold policies and investment in technology that have enabled the relatively hopeful trends that we see in renewables and electric vehicles must be replicated across other sectors to achieve our climate goals. Now looking at adaptation finance, and just to give a brief description of what we mean by that, adaptation relates to solutions that protect against the effects of climate change. And so, for example, drought-resistant crops or flood defenses. And over the past decades, there's been an increased appreciation of the importance of adaptation finance to help those countries that are most affected by the impacts of climate change. The compound annual growth rate of 16.7% of adaptation financing is higher than climate finance in general, which is largely driven by mitigation finance. However, this growth rate stems from a low starting point and needs to increase significantly in the coming years to help countries prepare and recover from the natural disasters that will become more frequent and more severe as temperatures continue to rise. The progress goals made during last year's COP commits providers to doubling annual adaptation financing by 2025 relative to a 2019 baseline. And it's crucial to the resilience of those countries that are most affected and least able to meet the cost of adaptation that this commitment is adhered to and does not follow the slightly disappointing outcome of the pledge to provide 100 billion a year in climate finance to developing countries that was agreed upon in the Copenhagen COP of 2009 and was unfortunately not met in its entirety. So we move now to the geographic distribution of climate finance. This graph in this slide comes from our 2020 landscape of climate finance and shows regional finance levels. And this broadly reflects the picture of the last decade as well. So as you can see, East Asia Pacific receives the greatest amount, predominantly as a result of China, with Western Europe and North America following. Regions receive significantly less, and this really must change in the coming years to ensure a global and equitable transition to net zero. This graph also shows regional finance needs using data provided by the IPCC. And as you can see, no region is currently reaching the levels of financing that are estimated to be required to reach our climate goals. And this again, reflecting the dramatic scaling up of climate finance that's needed. So I'll now pass on to my colleague, Paul, who will discuss how climate solutions are being financed.
Thank you, Jake. One of CPI's main objective in tracking is to identify the sources of finance that are investing in climate solutions. So by providing this information, at a granular level, we hope to provide transparency on which actor types are taking action, which are the ones lagging behind, and also what financial instruments are being used. So if we look at public sources, climate finance from public sources increased at a compound annual growth rate of just over 9% between 2011 and 2020. Development financial institutions, so namely national, bilateral, and multilateral development banks, are now providing 3 to 4 times the levels of climate finance they did back in 2011. Many of these institutions have had quantified climate investment targets for some years now, and we do observe a progressive mainstreaming of climate concerns among these institutions. But change is not only a matter of volume of finance. Public sources roles are also evolving with maturing markets. For example, at the beginning of the decade, 2/3 of National Development Bank funding went to renewable energy and energy efficiency projects. But in recent years, we saw low carbon transportation taking over as the main sector funded by these actors. Transportation, and more specifically the electrification of vehicles, as said earlier, is also a segment governments have been particularly engaged with, notably through substantial grant and subsidy programs to support market uptakes of electric vehicles. That said, public finance must increase at a faster pace over this coming decade, and public disclosure of climate finance data should also become simply the norm. If we now look at private sector over the same period, really, we find that investment has grown at a slower pace with only a 4% compound annual growth rate. Again, this overall trend is not quite representative of the dynamics and roles among private actors. Let's start, for example, with non-financial corporations or corporates. So that's the darkest shade of red on this graph. So historically, they represent our largest single class of investors, and many are established energy-related corporates specialized in renewable energy development. But we are now also capturing a growing share of non-energy corporations investing in electric vehicle fleets and implementing energy efficiency measures in their offices, for example. Similarly, with electric vehicle sales on the rise, households or individuals simply play a central role in climate finance nowadays. And given the rollout projections of electric vehicles, they could bear an even greater one in the coming years. However, without greater financial support, the energy transition can only lead to more inequalities. Households with less financial means could be left behind, with greater reliance on fossil fuels to heat their homes, commute, and cook, and so on, and exposed to ever more volatile energy prices. And finally, commercial financial institutions like commercial banks have dramatically increased their investment in climate solutions, notably in the really recent years. And note that this is also partly due to our methodological improvements on our end. So finally, the growth rate among private actors must increase rapidly this decade, and the deep pools of private capital available worldwide are urgently required to finance the transition to net zero, and public actors alone simply cannot have the resources necessary to do so. Finally, we can have a look at the financial instruments that these actors use to channel climate finance. Together, debt and equity make up for 95% of tracked financial transactions. What is quite striking here is that over 80% of climate finance was provided in the form of debt or equity, expecting market rate returns on investment. At the same time, we know that concessional financing is crucial to manage the risks and uncertainties related to early technologies and market that climate action partly relies on. The other hot topic is debt, of course. One of the big concerns when we mentioned debt is whether climate finance is contributing to increasing the risk of over-indebtedness of developing economies. So we're not fully able to answer this question, but our data give some early indications. So let's break down our debt figures a bit. So China aside, the majority of climate finance debt that we track are in fact transactions that only involve developed economies. That means either domestic transactions or a transaction between two OECD countries. Again, leaving out China, private and public debt transactions from developed to developing economies only account for just a fifth of the debt flows we track, and half of these flows are concessional debt transactions. So in short, the 61% debt you can see, percent of debt you can see on this graph encapsulates many types of debt transactions, many of which do not participate to increasing over-indebtedness in developing economies. I will now hand it over back to Baisa to discuss the road ahead for climate finance.
Great, thank you very much. So landscape analysis have evolved over the years with methodological advancements, but also data advancements by the reporting institutions. And in this sense, public and private actors have been key contributors on making this data available. But here I'd like to note that climate finance trends were not just driven by increases in information, but it was really the increases in flows. So the data improvements helped us to understand climate finance trends in a more granular level. So really reporting institutions and making this data available is what makes our reports feasible. So that's why these standardization efforts and also reporting efforts by various public and private institutions is really key. However, data gaps still persist. We still have lots of unknowns in climate finance, and more efforts are now required to standardize understanding of climate finance impacts and its outcome to climate goals. So moving on, we'd like to conclude with some of our observations and 4 key actions that CPI thinks would be key in driving investment into climate mitigation adaptation. We all know that climate transition presents a tremendous opportunity across a range of sectors and regions. Unfortunately, the current rate of investment is not going to lead us where it needs to be. So to overcome this, our 4 key recommendations are around these areas, and I'll describe them individually now. So adopting holistic sectoral strategies, the key word here is really the holistic. So the current blind spots in our response to climate change must be acknowledged and addressed. So what we mean is we need to build sector-wide decarbonization and resilience strategies that spur systemic transformation. So really taking from cradle to grave and ensure implemented solutions are well integrated. This also means that we shouldn't leave any sector behind. So from climate perspective, agriculture, forestry, and land use, buildings and the industry sectors are particularly underfunded, despite the crucial role they play in our lives. And the second one is about shift to finance paradigm, and to implement those holistic sectoral strategies that I mentioned. Public and private actors now need to coordinate, but not just with each other, but also internally, so that every actor really needs to know which part they can play, and who should be doing what and how they should be working together. But that alone will not obviously be enough, and we need to shift our thinking. So investors also need to think beyond short-term financial returns, really think about long-term and how it's going to affect how the risk and return profiles will change. So it's a very complicated area, but it's really mandates us to think innovatively and also look for innovative financial mechanisms that could be deployed at scale. And third, we've seen through our observation of decades of data that policies actually lead the way, and successes achieved in the energy sector must be mirrored in other sectors, as my colleague Jake highlighted. And then finally, fourth one, making decision critical data on climate finance flows available. Public and private sectors should work together to have a common definition on climate expenditure. And this was really going to help also build a dialogue with each other on the area of where they can play a role, but also collectively and progressively assess where the climate finance flows are stacking up against the needs, so that we can understand how we can update our strategies going forward. So in addition to regulators here, initiatives such as GFANS and TCFD could really support through detailed guidance on reporting investment in climate solutions. So before we move on to the Q&A section now, I'd like to just quickly mention some of the key climate finance trends. I'm sorry, if you can go to the previous slide, that we need to reflect in 2023. This is not an exhaustive list, but we just wanted to provide some highlights. So for example, this year is an important year for the global stocktake. So that's a stock on the implementation of Paris Agreement. And then in parallel, there are technical discussions happening for the new collective quantified goal to set before 2025. This will be set from the floor of 100 billion and would take into account the needs of developing countries. So definitely a very important discussion that we will be following very closely. And we are seeing that climate finance discussions are becoming more and more sophisticated, and rightly so. So for example, there are JETPs, Just Energy Transition programs. These are large-scale country-led programs to pursue an accelerated just energy transition away from fossil fuels and towards renewable sources. So we talk a lot about COP28, but let's also remember COP16, which focuses on biodiversity. And here, biodiversity and climate change will continue to be interlinked subjects. And on one hand, we cannot address biodiversity loss without tackling climate change, but it is equally impossible to tackle climate change without addressing biodiversity loss. And protecting and restoring ecosystems can help us reduce the extent of climate change and cope with its impact. Right. So here is just a list of other interesting research pieces that CPI has been working on that can also complement our analysis. So for example, Net Zero Finance Tracker monitors a wide range of actions that signal progress on financial alignment with the Paris Agreement. We aim to have an updated version of this tracker by May. And then in addition to that, we also have a framework for sustainable finance integrity, and also a range of regional, country level and thematic deep dive studies on climate finance. Great, thank you very much for your attention, and I'll open the floor for question and answer session now. I see, so first question was quickly on the differences in, okay, so these are some of them are answered. Could you give insight into how loss and damage proposition by natural disaster vulnerable and low carbon emission nations could affect climate finance landscape? And then there's a second question around technically what makes adaptation underfunded, yet adaptation is the priority need for developing countries. Perhaps we can bundle up these questions. So I can give a crack on that, but feel free, Paul and Jake, to complement. So loss and damage is a fairly new topic that's currently being discussed. And there's a lot of currently unknowns on how to define it and what will be the differences and similarities, but also overlaps with climate finance. So here, there's still technical discussions need to be done to understand how loss and damage is similar or different from climate finance, and we'll be looking into that. So on the question about what makes adaptation underfunded, yet adaptation is the priority need for developing countries. Yet again, adaptation is one of the sort of technically complicated issues. It's very difficult to define what adaptation finance is, whereas for mitigation finance, usually most projects are sort of easy and easier to monitor progress. So you have a very clear GHG emission reduction targets, whereas for adaptation, there are so many multiple indicators that you can measure progress against. And so in that sense, on one hand, it's an emerging topic and the finance flows are still very small, but on the other hand, there's an increasing need to invest more in adaptation solutions. Yeah, I think I'll perhaps Paul or Jake, if you have more to add to these questions.
Yes, thank you, Baisa. Perhaps on the adaptation point being underfunded, it's also really underfunded compared to some mitigation projects when you compare the two figures, and that is mostly because the money goes where projects are commercially viable and some returns can be made. And the typology of projects that happen in the mitigation space are much more prone to such returns as well. So it's also a matter of comparing the two.
Yeah, and one potential point is also that's interesting is the fact that, for example, in our Africa landscape that we published earlier on in the year, in regions such as Africa where adaptation is more of a need, the ratio is more like 50-50 compared to other regions. So, I mean, that might speak to the low levels of mitigation finance more than the high levels of adaptation finance, but that the ratio is slightly better in regions where adaptation is more urgently required.
Great. So yeah, there are like lots of questions here. So
there was a question about quick question about how the AFLU sector is broken down that I can quickly answer.
Yeah, sure. Thank you.
So we're not able to categorize at the subsector level all the flows that we track, but in 2019 and 2020, it is as follows. So forestry makes up for about 40% of the AFLU investment that we track. So forestry being reforestation, afforestation, sustainable forestry management practices. Then 38% of it is agriculture projects, again, climate smart practices such as agroforestry. And then there's a chunk that we're not quite able to categorize. And also we track around 5% of policy and national budget support or capacity building, the type of investment that support the enabling environment of some of the practices that I described earlier.
Great. So for next ones, I thought to bundle some of the methodology related questions. So one is, what would be the difference between CPI methodology and the OECD? Then there's another question around, do you have preliminary data for 2021 and 2022? Any insights, especially on 2022, how climate finance flows were impacted by energy crisis and rate hikes? And then the third question on the national CPI landscape, what is the level of granularity of climate finance data, and how do you deal with the challenges of estimating climate finance from the private sector? So maybe I think Paul would be great if you can start and we can complement.
Yes, at least on that last one, and the difficulty of tracking private sector flows. We have some data gaps in the private sector, especially what we call finance sheet debt, which is really hard to track because we need to have access to basically corporations' financial sheets. We track a lot of the private finance that we track are in renewable power assets, which are big projects with that are easier to track in general. Same thing with electric vehicles, basically any mitigation project where there's an investment made into a physical asset. It is easier to track private investment, but a lot of them we're not able to track.
So just on the OECD and CPI methodology, so one thing is we have different scopes. So we assess the global finance flows, whereas the OECD one is specifically around international climate finance flows from developed to developing countries. So, I mean, you know, in terms of use and purposes, probably different reports, but we are reliant on what public and private investors are disclosing and, you know, and calculating as climate finance provided. And the other difference is that there are different components in the OECD report where you can see mobilized private climate finance, where they make attributions of, you know, how public finance was able to mobilize, whereas we don't do that attribution. Our approach is really looking to project level data and try to trace it back to who were the providers of that information. So in terms of scope, we're different. Methodology wise, we're sort of similar, but there are some differences, I guess. And I think there was one question around granularity of climate finance data, which Paul, you covered, but I'm wondering, Jake, if you'd like to complement that.
Yep, so we aim to provide, or the data we use typically comes from project level data, so we don't want to make any estimations wherever possible. And like I think both Paul mentioned earlier, we don't track investments, so we don't know where it's going at this point. So every dollar we track within the global landscape, we ideally and most of the time do know exactly where that project, what project that dollar is funding. I think the second part was around estimations. So yeah, we do some where it's absolutely necessary, but we try not to. And most of our private data comes from sources like Bloomberg New Energy Finance and IJ Global, which means that we don't have to rely on estimation in private finance all that much.
Great. So there are some other questions related to current trends and the expectations of the current macroeconomic conditions and its impact on climate finance flows. So I think I'll try to bundle them as well. So one question from Allegra, it's about the current debt crisis, our growing issue of debt in emerging markets, and the ability of these countries to attract climate finance. What are your predictions for climate financial flows given this macro context? This is a very interesting question. Then there was one question around what do you anticipate in terms of movement at the spring IMF World Bank meetings in line with Mia Motley's Bridgetown agenda? So that's quite a high level question. Then the other one was around key topics in COP28, what UAE will take leadership on for its COP28 presidency. So yeah, I think these are quite open-ended questions. Yeah, I think we can answer that. Paul, would you like to start?
Yeah, I can start with at least the recent trends and projections for the coming years, and given the context, we have some early numbers for 2021 and just some really early indications of market trends in 2022. But we don't have final numbers yet. What we saw, though, for example, in 2021 and even in 2020 to some extent, is that some of the mitigation projects are more resilient to certain shocks than non-renewable assets. For example, if we take car sales in 2020 and 2021, there was a clear drop in internal combustion engine cars sales, but the electric vehicle sales kept growing. The current pace is so strong currently that even when economic shocks arrive, they manage to continue their growth. And this growth is likely to continue in 2021 and 2022. So our expectation is that just through the uptake of certain technologies that are growing really fast currently, the total numbers are going to continue to grow. We don't have a good sense of exactly the typology of projects and the trends at the sectoral level in 2022 yet.
Thank you, Paul. So I'm happy to take the Bridgetown question, because I think that's a very interesting and topical discussion that's happening out there. So it's a set of initiative and core messages to really change the global political thinking around global finance architecture and make it fit to address the climate crisis. And as Mia Motley says, country by country increase of ambition is not going to help us. There needs to be a global movement, a diplomatic movement at the global level to set changes. So what it really does is there are a set of ideas in terms of reforming multilateral development banks and the likes of World Bank and the International IMF, and also looking into SDRs on how special drawing rights can be designed such that it doesn't address after the crisis happened to rebuild, but these needs to be allocated before the crisis happens and things like that. So there's a lot of interesting discussions around that, and I think this is much needed discussion, and this is really driven by what we've seen in our report trend, right? So there needs to be step change, and CPI has been saying that for years now, and to reach this kind of scale, like from billions to trillions, I think this kind of movement is necessary. But I think what would be interesting to see is how developed countries is going to react to that, how they will engage into this discussion, and what kind of concrete actions they can come up through this Bridgetown agenda. I think there was one more question that I feel like we haven't addressed. So it was around the trends, right? Okay, so we can move on to the other questions.
Yeah, so there was a question around how we subdivide debt between green finance and transition finance. So
okay,
perhaps we can quickly answer this. So we do not include transition finance as part of climate finance. Transition finance is a hot topic as well. But in our definitions, we align our climate finance definitions with some of others, as mentioned previously, such as MDB's definitions, and we do not track as part of our numbers transition finance.
Yeah, so this would be a separate scope of work, and our sort of analysis is limited to only climate finance, but it doesn't mean that transition finance is not important. It's an important topic to look closely. Right.
Just to complement by that means that in our, for example, in our energy numbers, there's no money flowing towards nuclear. There's no money flowing towards natural gas either, just to be clear.
Great. Right, so there's one question around enabling environments, and I think, Jake, it might be interesting for you to answer. So what do you think can be done to strengthen enabling environments to mobilize private finance for climate action?
Thanks, Bessa. So we mentioned this briefly in our key points. So the enabling environments are really around, for us, it's really around improving the rate at which technology is developed, and then also producing those government policies that can facilitate solutions being scaled up when they are sort of technologically mature. So we've seen this in electric vehicles, we've seen this in renewable energy. There's kind of an initial investment into early stage technology, which enables this, this technology to be developed. And then it's incumbent upon governments to make it sort of financially viable and financially attractive for private investment to flow into those sectors and to scale them up, and continue to allow them to scale, as we've seen in, for example, offshore wind in the UK and other places in Europe, and electric vehicles in Norway, for example. It's all big policy decisions that enable private capital to get returns.
Great, thank you, Jake. There's one interesting question on improving the granularity of data, especially related to private debt finance from commercial banks. Is there something that private financial institutions, banks could do to improve the granularity and transparency of such data? Yeah, no, I think it's such a good and important question, because private finance, we've seen their involvement is increasing. A lot of net zero coalitions are happening. There's a lot of movement around data transparency and granularity, but current initiatives has been mostly focusing on financed emissions or risk assessment, climate risk assessment, but there's not much happening really around making data available in terms of what they are doing in terms of investing to climate mitigation and adaptation activities, which feels very counterintuitive, because really to go get to net zero, we need to spend money to climate mitigation activities, but that information is not mandated to be provided by private institutions. But it's important to know that public institutions such as development finance institutions, or within the context of the OECD 100 billion report, and also donor governments have been working a lot, and they've developed some very good and processes to make that data available. And I think there's a lot to learn from them, and it makes sense to align these reporting methodologies so that public and private finance is comparable. So I think this is why we've proposed in our key recommendations that it's not just the regulators that need to impose that, but also the voluntary reporting institutions like GFANZ or TCFD should really take this issue as a priority and start having private sectors. It's not just commercial financial institutions, all private sector investors to start reporting on what they're spending on climate mitigation adaptation. Right. Just want to ask Paul and Jake if there's any question that you'd like to answer live.
Yes, there's a question on how the track flows compared to the needs in developing economies alone, and asking if there's still a 20% year-on-year increase by 2030 needed. I cannot answer specifically on the number, but and there was a graph about this early in the presentation. We see that no matter at least the geographical breakdown, which is a good indication of this, you take the tracked amounts are never where the needs need to be. So there's still a gap, no matter the geographical breakdown you take or the country breakdown you use.
Thank you. Right, there's one question on the gap. How will the gap look like if only developing economies are included?
Yeah, that's the one I just answered myself, sorry.
Right, okay. So there's a question around OECD, Oxfam report. The real allocation is lower than the OECD claim public finance. How could those claims be resolved? Yes, we are aware of that report. I mean, we obviously are not the authors of that report, but just based on our observation with working with data is that we've seen that climate finance commitment. So it's a decision by the board on allocating finance flows to specific projects. So information related to that is more accessible, whereas the data related to actual disbursements of climate finance is not very readily available. So it's also a matter of the data availability and also how the recording between the provider and recipient is made consistent. So that's why it's a little bit difficult to say that the real allocation is so much lower in a very crystal clear way. Right. So I think we can take one more question. So there's a question around, is there an indication that public and private sector difference in urban and rural territories? So just on that, we'd recommend you to have a look into our state of climate finance for cities. So that's a dedicated study that we've done in 2021, looking into what is the climate finance allocated to the city level and the urban level. So that could be an insightful report for you to have a look at. Right. So I'm just trying to remember which questions we've answered and which ones we haven't answered. Okay, there's one on what is the current global landscape on climate budgeting. So I assume that this refers to public domestic budgeting, which is a little bit different to what we do. So domestic climate budgeting is an important initiative done by the government, so the governments can really assess what is the current climate spending and the projection going forward. So here we, in the past 10 years, we've been doing climate finance assessment. We've been really trying to see where we can get a comparable data on climate budgeting across different countries. And the big challenge we have is that information is not, usually available. And if that's available, it's done only for certain years. So we find climate finance budgeting information in 2015, 16, but that wouldn't be done in the subsequent years. But this is such an important thing to do for all governments, right? Like when you do your regular financial budgeting, it's quite imperative to assess how much they've been spending on climate, but also how much they need to allocate for climate budgeting, but also for coordination between different ministries, and also coordination with international climate finance providers, and improve the efficiency of spending. But we think that climate budgeting is not really done at a regular level. All right, so I think we should be fine with all the questions, unless Paul and Jake, you think there's something that we have missed.
Nothing on my end.
Not me.
Great, thank you so much all. We can close the webinar now. So I would just like to thank all of our presenters, Baisa, Paul, and Jake, and all of you who tuned in. As I mentioned, the recording and the slides that were used today will be available on the CPI website by tomorrow. I shared the link in the chat, so it should be up there pretty soon. And yeah, that's all. Have a great day, everyone. Thank you.